Imagine paying millions of dollars in taxes every single year for a factory that just doesn't even exist.
Right.
And paying for pollution that was literally never emitted in the first place.
It sounds totally absurd, but it's happening right now.
It really is. So, welcome to the deep dive. Today, we are looking at how massive global enterprises are bleeding, like up to 40% of their sustainability margins to something called phantom carbon.
Yeah, phantom carbon. It's a huge issue.
And we're going to explore why the multi-million-dollar fix to this massive balance sheet leak, it isn't some trillion-dollar generative AI breakthrough.
Right, it's not blockchain.
Exactly, not blockchain, not some sprawling network of physical IoT sensors across the globe.
No, the solution is actually just the humble, decades-old application of OCR optical character recognition to a standard monthly utility bill.
Which is just wild to think about, scanning a piece of paper.
Yeah, it is. I mean, it's a total masterclass in first principles thinking. We're looking at a situation where the stakes of corporate sustainability have, they've moved entirely out of the realm of just PR and marketing.
Oh, absolutely.
They are squarely in the realm of urgent, intense financial liability.
Yeah, real money on the line. And to understand the mechanics of this today, we're pulling from a really phenomenal stack of sources.
We have some great material to work with.
We really do. We've got these strategic top-down insights from McKinsey focusing on Scope 3 materials value chains.
Which really sets the macro stage.
Right. Then we have a highly rigorous methodological breakdown from Climatic. They get deep into the nuances of carbon accounting.
The real math of it all.
Yep. And we're grounding all of this in a laser-focused operational thesis by deep tech analyst Prasad Bond. He introduces the actual mechanics of what he calls the Scope 3 data bridge.
Which ties it all together beautifully.
So our mission for you today is to break down exactly how extracting data from mid-market supplier PDFs solves a global compliance nightmare.
And how it recovers that lost margin.
Exactly. And how it gives chief sustainability officers, CSOs, the ultimate operational leverage that they so desperately need right now.
Because right now, I mean, we live in an era where tech founders are constantly pitching these incredibly dense black box predictive models to solve ESG compliance.
Oh yeah, every week there's a new startup pitching an AI dashboard.
Right. So the idea that the key to saving massive corporate capital actually just lies in reading a supplier's electric bill. It's completely counterintuitive.
It's subversive, really, but it makes perfect sense when you look at the physical and organizational realities of a global supply chain.
It really does.
To understand why an OCR scan of a utility bill is so revolutionary, you first have to understand the totally impossible situation that massive enterprises are currently trapped in.
Yeah, let's talk about the regulatory blackout.
Exactly. There's this regulatory blackout happening driven by huge mandates like the EU Corporate Sustainability Reporting Directive, the CSRD.
And the Sustainable Finance Disclosure Regulation, the SFDR.
Right. And these mandates, they're forcing manufacturing enterprises to report on their Scope 3 emissions.
Which is the hardest part.
It really is. And just to set the baseline for you as we dive in here, we aren't talking about the relatively straightforward stuff.
No, not the easy wins.
Right. We aren't talking about the fuel the enterprise burns in its own delivery trucks or the electricity it buys to keep the lights on at corporate headquarters. That's Scope 1 and 2.
We are jumping straight into the labyrinth today. Scope 3.
Specifically Scope 3.1, which is purchase goods and services.
Exactly. Because for a major manufacturer, Scope 3.1 is the lion's share of their carbon footprint.
It's massive.
It is. It's the upstream emissions from your suppliers creating the raw materials. I mean, if you're an automotive company, it's the carbon emitted by the foundry that forged your steel.
Or the plant that molded the plastics.
Right? Or the factory in Taiwan that built the microchips. And the McKinsey research actually highlights that for companies whose emissions are 40% or more in that Scope 3 category, frameworks like the Science-Based Targets Initiative require them to have validated Scope 3 targets.
Validated targets. So this is no longer optional.
Not at all. It's a hard regulatory requirement.
But here's the structural impossibility of that requirement. Scope 3 requires highly granular data from entities that the enterprise does not actually own.
Yes.
And this is exactly what Bond's thesis zeroes in on. It creates this unbelievable organizational choke point.
Let's really look at the control dynamics of that choke point because it's fascinating. You have the chief sustainability officer at the enterprise.
The CSO.
Right. The CSO hold all the regulatory liability. If the company fails in the EU CSRD audit, the regulators are looking directly at the CSO.
And the board of directors is absolutely looking at the CSO.
Exactly. But, and this is the crux of the whole dilemma, the CSO lacks the operational authority to actually force compliance down the chain.
They can't just make them do it.
No. They cannot just walk onto the factory floor of an independent steel foundry in Ohio or a packaging plant in Vietnam and start installing smart meters on their furnaces.
Because they literally don't own the facility.
Exactly. They have no jurisdiction
Okay,
there.
hold on. Let me stop you right there. Because I think anyone looking at this from the outside would immediately ask if the mass in enterprise is the one writing the multi-million-dollar checks to these mid-market suppliers, right?
Yeah, the big clients.
If they represent a huge chunk of that supplier's annual revenue, why is the CSO powerless?
It's a fair question.
I mean, can't they just make data compliance a hard condition of the contract? Can't they just say, hey, Tier 2 packaging plant, install these IoT smart meters we're sending you, or adopt this specific ESG tracking software, or we pull our business?
It's a completely logical question from a high-level strategy perspective, but it completely ignores the brutal operational realities of industrial supply chains.
Okay, tell me why.
It basically comes down to two things: friction and internal corporate politics. First, consider the supplier. We aren't talking about other multi-billion-dollar conglomerates who have their own massive ESG department.
Right, we're talking about mid-market guys.
Exactly. Foundries, specialized chemical processors. These are independent, often family-owned businesses operating on incredibly tight margins.
And they're experiencing massive ESG fatigue right now.
Oh, complete fatigue. They're getting bombarded by all of their corporate clients with different, incredibly complex spreadsheets and software portals demanding data on their carbon footprint.
Just endless forms to fill out.
Right. From the supplier's perspective, this is unpaid administrative labor. If you tell a mid-market foundry manager that they need to pause production to install proprietary submeters on their equipment, or
ask their floor managers to spend 3 hours a week learning a new sauce dashboard.
yes, you are actively disrupting their operational rhythm. You're threatening their livelihood. They view it as a massive distraction that doesn't help them pour more steel or print more boxes.
Okay, I get that. But what about the threat of pulling the contract? Like, do it or we walk.
Well, that brings us to the internal politics. Because the CSO doesn't own the relationship with the foundry.
Procurement does.
Procurement owns that relationship. And procurement will fight the CSO tooth and nail on this.
Because their incentives are completely different.
Completely different. Procurement's mandate is to secure cheap, reliable, high-quality materials on time. If they have a reliable steel supplier who consistently hits delivery targets and price points, procurement is absolutely not going to jeopardize that vital relationship just because the supplier won't log into the CSO's new carbon dashboard.
Wow. So it's basically a game of corporate telephone where the person making the demand, the CSO, has the absolute least amount of leverage.
Exactly.
The CSO asks procurement reluctantly asks the supplier ignores the email because they're busy, actually running a factory.
Yeah.
And the enterprise just hits a brick wall.
And this friction leads directly to the enterprise's current fallback method. Because the CSO cannot get the actual physical energy data from their Tier 2 suppliers.
And the reporting deadline from the European regulators doesn't just disappear.
Right. The clock is ticking. So they're forced to guess. They have to retreat into abstraction. And that guess is what opens up the massive financial leak that Bond identifies.
Right, the financial trap, this concept of spend-based accounting. Because the CSOs are locked out of the physical reality of the factory floor, they default to what has unfortunately become the industry standard.
Which is deeply flawed for this specific use case.
Can we break down exactly how this spend-based math actually works? Like, how are they doing this today?
Sure. So spend-based accounting takes the monetary value that the procurement team spent on raw materials, and it multiplies it by a generic industry-wide emissions factor. So let's say your procurement team spent $5 million on steel from that foundry in Ohio. The sustainability team takes that $5 million and runs it through massive macroeconomic databases, environmentally extended input-output models.
Like Exiobase.
Exactly. Exio-base is a big one.
Okay, let's pause on Exio-base for a second. What exactly is an environmentally extended input-output model? How does it actually make that calculation?
Well, these models look at the entire macroeconomic flow of a country or a specific region. They look at the total economic output of the steel sector in a country, and they divide that by the total reported carbon emissions of the steel sector in that country.
So it's a massive
A
average.
huge average. It gives them an average carbon intensity per dollar spent.
Hmm.
So the model might say, in this region, for every dollar spent on steel, an average of 1.5 kilograms of CO2 is emitted.
So if I spend $5 million, the database just spits out an estimated 7.5 million kilograms of CO2.
That's the math.
But that is fundamentally an abstraction. You aren't measuring actual smoke coming out of a smokestack. You're measuring dollars on a ledger and just hoping they correlate to smoke.
Hoping is definitely the operative word there. Now, I mean, we have to be fair to the methodology here because the climatic source points out that spend-based methods aren't entirely useless.
Right, they have a place.
They do. In fact, frameworks like the GHG protocol actually recommend them for certain use cases. If an enterprise is just starting its carbon accounting journey, spend-based data is incredibly useful for initial high-level screening.
To see the big picture.
Yeah, it helps you map your entire universe of spend quickly to find your massive hotspots.
And Climatic also mentions it's perfectly acceptable for high-volume, low-impact categories. Things like office supplies, the catering budget, the corporate break room coffee.
Exactly. I mean, trying to track the exact life cycle carbon of every paperclip or every bag of coffee beans is a severe misallocation of resources.
It's a waste of time.
Total waste. The carbon impact is negligible compared to the rest of the supply chain. So spend-based accounting is the perfect, efficient tool for those categories.
But, and this is where the whole strategy falls apart, Climatic explicitly states that spend-based models fail drastically when applied to high-impact categories.
Yes.
You just cannot use the same math for the break room coffee that you use for $5 million worth of industrial steel.
And here's why the math gets terrifying for a corporate board. Input-output models like XU-base rely on national averages.
Right.
They assume price parity across the entire industry. They inherently bake in the inefficiencies of the absolute worst performers in the sector.
Oh, that makes sense.
Furthermore, macroeconomic data lags. The emissions factors you're using today might be based on economic data from 3 or 4 years ago.
So it's completely out of date.
Exactly. And the sources reveal that when applied to high-impact raw material supply chains, this spend-based method overestimates actual physical emissions by up to 40%.
40%, that is a staggering margin of error.
It's massive.
And this is what Prasad Bond terms phantom carbon. It is carbon that never actually existed in physical reality.
Right.
No coal was burned to create it, no natural gas was drawn. But because of these lazy macroeconomic accounting methods, it exists on the enterprise's official ledger.
Now, if you are sitting in a corporate board meeting right now, here is where you have to connect the dots on the financial mechanism.
This is the kicker.
This isn't just a number on a sustainability PDF that looks slightly worse than you'd like. Under emerging regulatory frameworks, enterprises are going to pay real, hard regulatory penalties and actual carbon taxes on this footprint.
Yes.
So if your carbon ledger is bloated by 40% with phantom emissions, you are bleeding corporate capital to pay a tax on a ghost.
Let me try to contextualize this with an analogy for you because the severance of price and physical reality is the key issue here.
It's the core problem.
Imagine you're trying to calculate your daily caloric intake. The accurate activity-based method would be writing down exactly what you ate, like 1 apple, 4 ounces of chicken, a cup of rice.
That's the physical truth.
Right, but you don't have that list. You lost it. So instead, you use a spend-based method. You look at your credit card receipt from the grocery store.
Okay.
Let's say you spent $200 at Whole Foods. The macroeconomic database says the average grocery dollar equates to 100 calories. Therefore, your ledger says you must have consumed 20,000 calories today.
Yes. And to make that analogy perfect, based on the financial liability we just discussed, imagine your health insurance provider or your doctor is actually fining you based on that receipt.
Fining you for 20,000 calories.
Exactly. Just because you spent $200 doesn't mean you ate 20,000 calories. Maybe you bought expensive saffron. Maybe you bought premium, low-calorie organic vegetables that cost twice as much as the cheap, high-calorie junk food.
Right.
The price on the receipt does not dictate the physical reality of the product you consumed.
And this severing of price and physical reality has just devastating strategic consequences for the enterprise.
It ruins their strategy.
Think about the procurement team we talked about earlier. Let's say your procurement team does their job brilliantly. They negotiate a massive multi-year volume discount with that steel supplier. The price of the steel goes down by 15%.
A huge win for procurement.
Massive win. But under spend-based accounting, because the enterprise spent fewer dollars, their reported carbon footprint magically drops by 15%.
Even though nothing physically changed.
Exactly. The physical steel didn't change. The physical coal burned to melt that steel didn't change at all. It is an accounting fiction.
Conversely, and this is where spend-based accounting actively destroys the corporate sustainability agenda, what if the CSO actually convinces procurement to choose a slightly more expensive but genuinely low-carbon supplier?
Okay, yeah, let's play that out.
Let's say they find a supplier using an electric arc furnace powered completely by a local wind farm. The enterprise decides to spend more money to do the right thing and buy green steel.
Which is what we want them to do.
Exactly. But because the spend-based model only looks at the dollar amount on the invoice and multiplies it by the generic industry average for steel, the company's reported carbon footprint actually goes up.
Oh, man. They get financially penalized for doing the right thing.
Because the model completely fails to reflect the reality of a green premium.
That is maddening.
It is. And the climatic source emphasizes this. Heavily humming prices do not correlate well with carbon intensity, especially when you factor in discounts, green premiums, inflation, and market fluctuations.
Right. Inflation alone messes up the math. If steel prices jump 20%, your carbon footprint shouldn't jump 20%.
Exactly. So if spend-based accounting is a lazy, expensive proxy that taxes the company for emissions that never occurred, the enterprise desperately needs to return to physical reality. They need primary activity-based data.
But we already established that they are locked out. They can't force the suppliers to install new IoT hardware or adopt new SaaS platforms because of the operational friction.
They're stuck.
So here is the multi-million-dollar question that Bond's thesis actually answers. How do you get physical reality without physical disruption?
And this is where we pivot from the problem to the solution. It requires a completely different way of looking at the data ecosystem. We have to apply first principles thinking.
Let's do it.
What is the fundamental nature of the thing we're trying to measure? Physical carbon emissions map directly to burnt fuel or drawn electricity. You cannot emit carbon in a manufacturing process without consuming energy.
It's just physics.
Right. Therefore, the absolute, unassailable truth originates at the physical utility meter on the side of the factory building.
The data already exists.
Yes.
The local utility company is already measuring it. And they're measuring it with perfect, regulated, audited accuracy because they are billing the supplier for it.
Exactly. The local energy provider has already deployed the hardware. They've already done the hard work of metering the facility.
The sensor is already there.
It's there. And this leads to the second first principle friction reduction. We know the supplier won't adopt new behaviors. They won't log into a new dashboard.
Right.
So what is a guaranteed existing behavior that the supplier already engages in every single month without fail?
They receive and they pay their monthly utility invoice.
Exactly.
The electricity bill, the natural gas bill, the water bill. They have to process that document or the lights go out on the factory floor.
Right. They already have a PDF or a physical piece of paper sitting in their accounting department that contains the exact primary data the enterprise needs. Therefore, the path of least resistance, the zero friction solution, is to simply intercept that invoice.
Right at the source.
Yes. Use an optical character recognition data bridge.
It is so beautifully simple. And you contrast this with the traditional tech approach, and it is almost comical.
It really is.
The sources point out how bootstrapped tech startups waste months, sometimes years, building these incredibly complex, predictive ESG software platforms.
With all the bells and whistles.
Yeah. They assume the problem requires deep algorithmic intervention. They build these massive visual dashboards with heat maps and real-time tracking graphs.
And the Tier 2 suppliers take one look at it and completely ignore it.
Right. Tech founders love to pitch complex AI models for ESG, but the actual operational bottleneck is so much dumber than that.
It's so basic.
CSOs literally just cannot get a PDF of an electric bill from a steel foundry in Ohio. That is the actual barrier.
With OCR bill scanning, the equation completely flips. The supplier experiences zero financial burden. They don't have to buy a sensor.
Nope.
and they experience zero workflow disruption.
Yep.
The enterprise simply says, when your accounting department receives your monthly utility bill, just CC this automated email address or drop the PDF into this secure portal.
And that's it.
That is the entirety of their obligation. It takes 30 seconds a month.
The elegance of that is stunning because it actually respects the supplier's time. But getting the PDF is really only half the battle. Because a CSO at a multinational company with, say, 5,000 Tier 2 suppliers across the globe can't just have 5,000 messy PDFs sitting in an inbox.
No, that's just a different kind of nightmare.
Right. To be useful, that stamped piece of paper has to be translated into the language of corporate finance.
Which brings us to the actual technical integration. How does OCR technology convert a simple, messy utility bill into audit-grade carbon data? And how does it get into the enterprise's systems? Let's trace the data pipeline from paper to ERP.
Okay, let's walk through it. Step 1, the OCR software ingests the standard utility invoice. Let's say it's a bill from a cooperative utility grid in Texas.
Okay.
Now, OCR isn't just taking a picture. How does it actually parse the unstructured data? Because every bill looks different.
Modern OCR engines, specifically those trained on utility invoices, don't just read text blindly. They look for key value pairs.
Key value pairs.
Right. Because utility bills are notoriously inconsistent. A rural Italian water bill looks completely different from a Texas grid bill. The layout is different, the language is different, the units might be different.
It's chaos.
Total chaos. But the OCR algorithm scans the document and identifies the critical nodes, the billing period dates, the total cost, and most importantly, the raw consumption metrics, the actual kilowatt hours of electricity, or the therms of natural gas.
So it literally lifts the physical truth right off the page.
It does.
But how do we know the algorithm didn't make a mistake? What if there's a smudge and it reads an 8 as a 3? If we are submitting this to EU regulators, it has to be flawless.
That is where the validation layer comes in, which is crucial. The software doesn't just extract the numbers and send them off. It cross-validates them using basic math.
Oh, clever.
Yeah, it looks at the extracted kilowatt hours, multiplies it by the extracted rate per kilowatt hour, and checks if that equals the extracted total cost on the bill.
Ah, so it checks its own work.
Exactly. If the math doesn't tie out perfectly, the system flags the invoice as an anomaly for a human to review. But if the math does tie out, the system locks that data in as an immutable verified node.
So now we have primary audit grade activity-based carbon data. It is not an estimate. It's an exact measurement of activity.
Which is exactly what the regulators want.
But as we said, it can't just sit in a void on a startup server. It needs to get into the enterprise's central nervous system. It needs to get into the ERP.
Right, the Enterprise Resource Planning System.
Yeah.
SAP, Oracle, Microsoft Dynamics. This is the financial core of the enterprise. And here is where we hit the massive IT bottleneck.
Oh, absolutely. If I go to my company's chief information security officer and say, hey, I want to let this third-party ESG startup write data directly into our legacy SAP instance, the IT team would rather die than approve that.
Oh, they'd laugh you out of the room.
They lock those systems down like Fort Knox for very good security reasons.
And rightfully so. Corporate IT notoriously restricts external API access to ERPs to prevent data corruption or security breaches. So how does the OCR data bridge get past the corporate firewall?
Right.
Bond details how this is achieved through a clean, single-purpose, restricted node API pipeline.
Explain how a restricted node API bypasses that InfoSec friction, because InfoSec hates everything.
They do. But the startup doesn't ask for deep system overhauls or broad read and write access to the entire ERP.
Right.
The API payload is designed to do exactly one thing: update specific emission factor fields for specific supplier IDs.
So it's super targeted.
It is a surgical injection of data. The ERP already has a static vendor profile for supplier X. It has their address, their bank details, their contract terms.
Right.
The API simply pushes the validated kilowatt hours from the OCR scan directly into a designated sustainability field within that existing profile.
It turns a static vendor profile into a dynamic carbon node. It updates monthly, automatically, without anyone touching a keyboard. And the business model behind this is brilliant. Bond calls it the verified data node fee.
Let's really look at the commercial mechanics of that, because it explains why this is scaling so quickly in the enterprise space. The enterprise pays a recurring SaaS fee to the tech startup that is facilitating this OCR bridge. And it is an incredibly asymmetric trade.
I love that phrase, an asymmetric trade. Let's quantify the potential cost savings here for you. Why is the enterprise thrilled to pay a few $1,000s a month for this tool?
Because the ROI is insane.
Because restoring that primary data eliminates the 40% estimation penalty we talked about earlier. If a multi-billion-dollar enterprise is facing a carbon tax of, say, $50 or $100 per ton of CO2 under emerging regulations.
Which is very realistic.
Very. And their Scope 3 ledger is bloated by hundreds of thousands of phantom tons due to spend-based accounting. We are talking about millions of dollars in hard tax liabilities.
Exactly. They are spending thousands of dollars on software to save millions of dollars in phantom carbon taxes. It is the easiest ROI calculation a CFO will ever sign off on.
It's a no-brainer.
The value alignment is perfect. The enterprise pays for the data and receives the massive tax savings, the startup gets recurring revenue, and the supplier gets left alone to do their job without buying new hardware. Everyone wins.
Now, let me play devil's advocate for a second.
Sure.
If the data is just sitting on a PDF and the enterprise stands to save millions by having it, why doesn't the enterprise just hire a massive BPO team, like a room full of data entry clerks in an offshore facility to just open the emails and type the numbers from the PDFs into SAP manually?
It's a common question.
Why pay a startup for an automated API bridge?
It ultimately comes down to scale and auditability. Let's look at scale first. A multinational enterprise might have 5, 10, 20,000 suppliers.
Easily.
These suppliers are spread across multiple countries, dealing with hundreds of different local utility companies, each with their own bizarrely formatted invoices in different languages and different currencies. A human data entry team would be overwhelmed by the sheer administrative chaos.
Right, trying to translate and manually input data from a regional grid in India versus a municipal water bill in Germany, it would be a nightmare.
But more importantly than scale, manual entry introduces human error. A clerk misses a decimal point or accidentally adds an extra zero, and suddenly a small packaging plant looks like it's emitting the equivalent of a mid-sized nation.
Which ruins the data.
Exactly. And human error fails strict regulatory audits.
Which is the entire point of this exercise, passing the audit.
Yes. An automated OCR system, backed by those mathematical validation checks we discussed earlier, creates an immutable, traceable pipeline. From the source document straight into the system. It creates a digital paper trail that proves exactly where the number came from. It removes human fallibility entirely.
And that transition is crucial, because this concept of auditability is exactly why this specific data mechanism isn't just a clever cost-saving measure for the CFO. It is the direct, unassailable answer to incoming European law.
Which is the real driver here.
Which brings us to the EU's CSRD and the power of primary data.
The EU Corporate Sustainability Reporting Directive is completely changing the landscape. They are not playing games with voluntary disclosures anymore.
The Wild West era is over.
It really is.
Yeah.
The CSRD demands granular, defensible reporting, and it introduces concepts like double materiality.
Let's break down double materiality, because that sounds like a phrase auditors use just to terrify executives.
Well, it is terrifying if you don't have good data.
Yeah.
It basically means the enterprise has to report not only on how climate change financially impacts their business, which is single materiality,
Okay.
but also how their business operations impact the climate and society. And crucially, the CSRD requires what is called limited assurance audits by 2024, moving toward reasonable assurance in subsequent years.
Meaning an external auditor, like someone from a Big Four accounting firm, has to come in and legally sign off on the accuracy of your carbon ledger, just like they sign off on your financial revenue.
Exactly. And as these regulations mature, relying on spend-based estimates is going to become increasingly dangerous. Auditors are going to look at the methodology, realize there is a 40% margin of error based on generic macroeconomic input-output tables, and they will flag it.
They'll throw it out.
They will demand proof of activity.
The climatic source emphasizes this exact distinction between spend-based and activity-based data. Spend-based uses the exo-based financial models. Activity-based relies on the actual liters of fuel burned or kilowatt hours drawn.
Right.
How exactly does the OCR extracted utility data satisfy those specific audit requirements?
Because the data originates from a third-party, heavily regulated entity. The local utility company that physically meters the factory is a regulated monopoly. The invoice they produce is a legal financial document.
Ah.
It isn't a projection created by the supplier to look good in a survey. It is empirically true. It is the very definition of activity-based data.
So if I'm understanding this correctly, the enterprise is basically legally co-opting the utility company's hardware to satisfy the EU regulators.
That's a great way to put it.
I mean, the utility company spent millions building the grid and installing the meters. By using OCR on the invoice, the enterprise gets all the audit-grade certainty of that physical hardware without having to deploy a single sensor themselves.
That is exactly what they're doing. They are leveraging an existing, trusted physical infrastructure, the global power grid's metering system, and turning it into an ESG compliance tool. And it solves the other massive pressure point for the CSO, which is time.
Right. Time to value. The CSRD deadlines are already rolling out.
If a CSO decided today that they wanted to deploy IoT hardware sensors across their entire Tier 2 supply chain just to get primary data, it would take years. Think about the logistics. You have to negotiate the data rights with every single vendor, procure the hardware, deal with supply chain delays on the sensors themselves, physically install them on hundreds of different types of industrial machines, calibrate them, and then maintain them.
It's a multi-year CapEx nightmare, but an OCR software bridge.
It can be spun up in weeks. You send a standardized email to the suppliers asking them to CC the automated inbox. The OCR engine maps the invoice formats within days. The API pushes it to the ERP.
Wow.
You instantly plug the compliance gap. You move from a state of total blindness and massive financial liability to perfect audit-grade visibility almost overnight.
And what happens when the CSO actually achieves that? What happens when they finally have this mathematically sound, activity-based data flowing smoothly into their ERP without having alienated the procurement team or the suppliers?
Their role in the company fundamentally transforms.
They level up.
They do. They stop being just a compliance officer desperately nagging people for spreadsheets to avoid fines, and they suddenly have the power to fundamentally reshape the business. They become a strategic partner to the CEO and the CFO.
Let's dive deep into the McKinsey insights here, because this frames the OCR data bridge as a pure leadership tool.
This is the exciting part.
Once the phantom carbon is erased, once the 40% bloat is gone and you have the real numbers, the enterprise can move from playing defense-like compliance and avoiding audits to playing offense, value creation.
The McKinsey article outlines several specific strategic levers for reducing Scope 3 emissions. And what is vital to understand is that none of these levers can be pulled effectively if your baseline data is just a generic spend estimate.
You're just guessing.
Right. You need the precision of the OCR data bridge to unlock them. Let's look at the first lever: supplier and customer selection. McKinsey talks about dual mission sourcing.
Dual mission sourcing, meaning buying a product that minimizes both cost and carbon footprint simultaneously. But remember our earlier discussion about the fatal flaw of spend-based accounting. If you negotiate a lower price, your footprint artificially drops. If you pay a premium for a green supplier, your footprint artificially rises.
The data is corrupted. So procurement is flying blind. They can't execute dual mission sourcing. But with primary OCR data, the CSO can finally give the procurement team an accurate scorecard.
A real scorecard.
They can go to the head of procurement and say, look, supplier A and supplier B charge the exact same price for aluminum, but supplier B's utility bills show they use 30% less energy per unit produced because they upgraded their machinery last year.
Wow.
Now, procurement can actually shift volume to supplier B based on physical truth, lowering the corporate footprint without increasing costs.
It empowers procurement to make real choices instead of just chasing the lowest dollar.
Right.
And the second lever from McKinsey is even more interesting, I think. Product specification and solutions, working directly with R&D.
This is where the data actually drives engineering. If a CSO has accurate, localized data showing exactly how much carbon is emitted to produce a specific thickness of a metal bracket, they can go to the R&D and engineering teams with a real proposal.
Like what?
They can say, if we redesign this component to reduce the thickness by 2 millimeters, or if we substitute this virgin polymer with a recycled filler material, we will drop our Scope 3 emissions by exactly X tons, which saves us Y dollars in carbon taxes.
You cannot do that with a generic industry average. A macroeconomic input-output table from 3 years ago won't tell you the carbon delta of shaving 2 millimeters off a bracket.
Not a chance.
You need the specific localized data that the OCR bridge provides to prove the ROI of that engineering change.
Precisely. You are driving product design through carbon transparency. The third lever McKinsey mentions is strategic partnerships. And they give some incredible real-world examples of how this is already happening.
Yes, let's look at those examples. They highlight Volvo Trucks partnering with a Swedish steel player to design vehicles made from fossil-free steel.
That's a huge one.
They mention Komatsu collaborating directly with their customers to deploy zero-emissions mining equipment. or Anglo-American and ThyssenKrupp Steel working together to develop high-quality input stock for lower carbon steel production.
Here is the critical connection back to our core thesis today. You cannot forge these multi-million-dollar strategic partnerships if your baseline data is a guess.
That's too much risk.
Way too much risk. If Volvo approaches a green steel supplier and agrees to pay a premium to co-develop a new material, the CFO is going to demand to know the exact return on investment. Volvo needs to know exactly how much carbon they are displacing to justify the capital expenditure. Primary audit-grade data builds the mathematical foundation of trust required for those partnerships to exist.
And having that undeniable mathematical foundation allows for something even more profound within the enterprise internal carbon pricing.
Oh, internal carbon pricing is the ultimate mechanism for institutionalizing sustainability.
How does it work?
Once you have transparent, accurate data flowing from your suppliers via the OCR bridge, the enterprise can assign a monetary value to every ton of Scope 3 carbon. They essentially create a shadow tax on their own internal departments.
So if a procurement manager chooses a dirty, high-carbon supplier just because they are 2 cents cheaper per unit, their internal departmental budget gets hit with that internal carbon price.
Exactly. It makes CO2 visible on the P&L. The procurement team is properly incentivized to choose cleaner Tier 2 suppliers, because the dirty suppliers suddenly look more expensive when you factor in the carbon costs.
That's brilliant.
It is. But again, you can only enforce an internal carbon tax if the data is unassailable. If you try to tax a procurement manager based on a fuzzy spend-based estimate, they will rebel.
Oh, they'll riot.
They will argue with the methodology all day.
They'll
But if you show them the physical utility bill of the supplier they chose, extracted and validated by the OCR bridge, the argument is over. It is an objective fact.
That is true operational leverage. Now, I have a practical question about the deployment of this. We've established that the OCR bridge is vastly superior to spend-based accounting for these high-impact areas.
Unquestionably.
But if we go back to the climatic source, they suggest a hybrid approach. Does the enterprise really need to use this OCR data bridge for every single supplier? Do we need to, scan the utility bill of the company providing the paper clips?
No, and that is where climatic's guidance is incredibly valuable for operational efficiency. We must avoid replacing one form of inefficiency with another. The expert approach is absolutely a hybrid strategy.
How does that look in practice for a CSO deploying this today?
You start by using the quick spend-based tools, the Exio-based models, to map your entire universe of spend rapidly. You run the procurement ledger through the database. That initial screening will immediately highlight your massive hotspots. For a manufacturer, that will invariably be Category 3.1, your raw materials value chain.
The heavy hitters, the foundries, the chemical processors.
Right. You leave the break room coffee, the office supplies, the corporate catering on the spend-based model. The carbon impact is negligible, the financial liability is tiny, and it is simply not worth the administrative effort to scan their utility bills.
It's just not worth the API calls.
Exactly. But for those high-impact Tier 2 nodes, that is where you deploy the OCR data bridge. You use the sniper rifle instead of the shotgun. You extract the precision data exactly where the 40% margin leak is occurring.
So you get the speed and broad coverage of spend-based accounting for the small stuff and the undeniable audit-grade accuracy of primary data for the stuff that actually drives your regulatory risk and your phantom carbon taxes.
It is the optimal allocation of resources. It balances the need for speed with the absolute requirement for accuracy in high liability areas. And it brings us to the ultimate realization of what this technology represents for the future of how global supply chains are managed.
It really does. Let's summarize the journey we've just been on, because we've covered a massive amount of ground today.
We started by looking at a well-intentioned global push for Scope 3 emissions reporting. Regulators want to save the planet, which is necessary. But the structural realities of supply chains accidentally created a massive financial trap for enterprises' phantom carbon.
Right. Because CSOs lacked operational control over their Tier 2 suppliers, they couldn't force them to install physical sensors or adopt complex software. So they defaulted to spend-based accounting, a proxy that simply multiplies dollars spent by macroeconomic industry averages.
And that abstraction forces companies to overestimate their high-impact emissions by up to 40%, meaning they are set up to overpay millions in regulatory penalties and carbon taxes for emissions that literally never existed in the physical world.
But the fix isn't some futuristic multi-million-dollar tech deployment. The most elegant, frictionless solution is to simply intercept the supplier's existing utility bill. You use an API-connected OCR bridge to scan the PDF, lift the raw kilowatt hours, validate the math, and inject that primary truth directly into the enterprise ERP.
It respects the supplier's time, it recovers the massive margin lost to phantom carbon taxes, it provides exactly the activity-based, audit-grade data required to satisfy the EU CSRD, and it transforms the CSO into a strategic leader capable of driving real value creation like dual mission sourcing and green product R&D across the entire supply chain.
It is a phenomenal synthesis of strategy and practical grounded technology. And it leaves me with one final provocative thought for you to mull over. We've just explored how a completely basic technology scanning a piece of paper can rescue billions in corporate capital simply by revealing the physical truth hidden inside a mundane administrative workflow. As global supply chains face increasing regulatory scrutiny, not just on carbon, but on labor practices, ethical sourcing, water usage, and conflict minerals, you really have to ask yourself what other trillion-dollar blind spots are currently being managed with lazy estimates, and how many of them are just waiting to be solved by someone willing to simply look at the paper trail that already exists.